Thank you for standing by, and welcome to a special investor call regarding the recently announced entitlement offer to raise up to 4.5 million. All participants are in a listen-only mode, so be rest assured that nobody else on the call will be able to see or hear you. There will be a presentation followed by a question and answer session that I will announce at the end of the presentation. To ask a question, please use the Q&A box on the control panel, or feel free to raise your hand to answer a question in person. Unfortunately, those joining by telephone will not be able to raise a question. I would now like to hand the conference over to Brent Barnes, CEO and Managing Director.
Great. Thank you, Debbie, and welcome everyone. Thanks for joining today's investor call. On the call with me today is our Chair, Rebecca Wilson, and our CFO, Ray Ridge. I'd like to remind those on the call that today's update may contain forward-looking statements which involve inherent risks and uncertainties. We recommend you do not place undue reliance on those statements, and actual results may differ materially from those forward-looking statements. Information discussed on today's call has been disclosed with the ASX. Announcements can be found on the LBT website for your review. Last Friday, the company announced an entitlement offer to raise up to $4.5 million in capital. In terms of format, I'll hand the call to our Chair, Rebecca Wilson, to talk through the offer. I will then provide a business outlook, and we'll end with a question and answer session. I'll now hand over to Rebecca Wilson.
Thank you, Brent, and good morning, everyone. On behalf of the board, I'm pleased to join today's call to provide information and, if necessary, clarity on the entitlement offer that we announced last week. I wanted to ensure that our shareholders had direct access to me, and I encourage your questions at the end of today's session. As you're all aware, LBT has for some time been in the position of needing to raise capital under what are challenging prevailing capital market conditions. I took over the role as chair only a few months ago, knowing these inherent funding uncertainties. However, I saw opportunity beyond the nearer term capital challenges and was motivated to join given what I saw was an inflection point, which went beyond the nearer term capital challenges. LBT is well positioned to capitalise on new market opportunities and able to focus on the execution of its commercial strategy. I'm acutely aware of the dilution of this raise, and I want to convey with sincerity to you that raising capital now was unavoidable for the company, and the alternative of not raising capital would have been a far worse outcome for all shareholders. With this acknowledgement that a capital raise has been necessary, our aim was to raise enough capital that would allow us to progress confidently to the next phase for LBT and allow Brent and his team to focus their attention fully on running the business. I'm therefore pleased the company has received underwriting commitments of $3 million. This provides funding certainty that has enabled the company to pay out the remaining $1.38 million of debt with Lind Partners, which cleans up our balance sheet and removes the potential for any future sale price overhang. This facility has been paid in full and made possible by one of the sub-underwriters providing a short-term loan to the company, illustrating the value and confidence of the underwriters in our outlook. I'll now explain the offer and encourage shareholders to review the prospectus available on our website, covering all the necessary details. The structure is called an entitlement offer, which means first priority is given to existing shareholders to participate and raise capital for the company up to a maximum of $4.5 million. As a shareholder, you're entitled to take up the offer on a 4-to-1 pro rata basis. This means that for every one share you own as a shareholder, you are entitled to subscribe to 4 new shares under the offer. You're also able to subscribe for more than your entitlement. The offer is priced at half a cent, which is 55% discount to the closing share price on the 12th of October 2023. For every 1 new share issued, you will receive an additional 1 share option. The structure is that 50% of the options have an exercise price of 0.005, so half a cent, with an expiry date of 10 months. The other 50% of the options has an exercise price of 0.008 with an expiry date of 24 months. Should the full $4.5 million be raised, a total of 900 million shares will be allocated, with an additional 900 share options. The board considered an entitlement offer the most appropriate structure for capital raising because it provides both priority and fair and equitable participation to all shareholders. To be clear, this offer is an entitlement for existing shareholders who have first priority ahead of anyone else to participate, inclusive of the underwriters. In the event that shareholders don't exercise their rights to take up the offer, any shortfall can be placed by the company. So shareholders have the surety of being able to participate to the extent they wish, plus we have the comfort of having a backup to ensure we raise enough for the company to advance freely. Directors are participating in this offer, collectively committing to $475,000 as sub-underwriters. Unfortunately, the offer has excluded persons living in the United States, which has meant that Brian O'Dwyer has been unable to participate in the offer. I'd now like to hand the call over to Brent to present the use of proceeds and the company outlook. Over to you, Brent.
Thanks, Beck. Look, over the last 12 months, the company is focused on tight expense management, which really was aimed to extend our cash runway. Net cash used during this last fiscal year, F23, for operating and investing activities were just $1.6 million. This is materially down from the prior financial year, largely driven by adding new revenue sources, so the funded research and development for APAS Pharma QC with AstraZeneca, cost reduction measures, including headcount reductions and improvements in cash receipts from customers. Proceeds raised from this entitlement offer will allow the company to improve our balance sheet and provide sufficient cash runway to launch APAS into the pharmaceutical market, where we expect sales to commence in the second half of calendar year 2024. To that end, proceeds from the offer are expected to be $0.9 million on product and market development for the APAS Pharma QC product, repayment of the structured debt facility of $1.38 million, which has now been fully paid, $0.8 million to support ongoing commercial sales for APAS in the clinical market, and $1.6 million of working capital. The costs of this offer are expected to be approximately $0.3 million. The journey developing our automated plate assessment system has taken longer and cost more than we expected. At this point, shareholders could consider this raise as a reset for the company, acknowledging the low market capitalization relative to our outlook. We have a platform that remains unique with a large addressable market. Sales into the clinical market remain slower than expected, and from an outlook perspective, we expect gradual build of sales. We do believe the product addresses a genuine need for clinical laboratories globally. However, anticipate a conservative sales outlook, which has been baked into our future cash flow expectations. Leveraging the same technology established for the clinical market, the company expects the pharmaceutical application to be the growth driver for the company. The reading of culture plates during the manufacturing of drugs is a routine and essential quality control process for pharmaceutical companies. The development of the new analysis module called APAS Pharma QC is well progressed, and first in-market data has been completed as part of our development program with AstraZeneca. Results were extremely positive, with the product demonstrating 100% sensitivity achieved for growth detection and positive feedback on the existing hardware platform, which is unchanged for this new application. We expect the LBT primary validation development and documentation to be completed early 2024 calendar year, with a formal launch planned shortly thereafter, and sales to commence in the second half of calendar year 2024. The APAS Pharma QC product was promoted for the first time at the Parental Drug Association annual Pharmaceutical Microbiology Conference in the US a couple of weeks ago. Next month, we will exhibit at PharmaLab, an annual conference held in Germany, where we expect AstraZeneca to present at the conference about their approach to validation of APAS within their business. This is the first time AstraZeneca is presenting their positive experience using APAS to date. We have engagement with 12 of the top 20 pharmaceutical companies, and that's by revenue, where discussions are at various stages of progress. And our goal is to commence validation of APAS with 2 to 3 new pharma customers over the coming 6 to 9 months. Our expectation is that each customer has the potential of multiple APAS instrument sales, representing a compelling market dynamic, which is different from our experience in the clinical market. To summarize our outlook, we expect a steady build of sales within the clinical market, and the funding from this entitlement offer gives the company runway to launch APAS into the pharmaceutical market, with sales expected in the second half of 2024 calendar year and building from there. Progress against this plan can be measured by additional pharma customers commencing their validation processes with APAS over this coming 6 to 9 months, which establishes a sales funnel of potential multiple sales of the instrument. I'll now like to hand the call over to Debbie to facilitate the question and answer session.
Thank you. We will now commence the question and answer session. Please remember, if you would like to ask a question, either use the Q&A function on the Zoom control panel at the bottom of your screen, or raise your hand and wait for your name to be announced. If you wish to cancel your request at any time, simply remove the raised hand. The first question comes online, and it asks, can you please summarize regarding 1, competitors, and 2, patents and protections? This is from Daniel.
Thanks for the question, Daniel. So look, on the clinical market, there are 2 kind of competitors, and we compete against what's called Total Lab Automation, and an Italian company called Copan exists in that market, and a US company called Becton Dickinson exists. So these are much larger instruments, retail for upwards of $1 to $1.5 million. So that's on the clinical side of the business. On the pharma side of the business, the largest competitor that exists is a company called Rapid Micro Biosystems, and they have an incubator and a reader technology, and they've got an install base of about 120 instruments globally. And they've been in the market for about 4 years. So I think it's a good example, perhaps, that demonstrates there's definitely a viable market that exists in that pharma space. With respect to patent protection, just the final question there, we have a family of 4 patents and have done for a long period of time, which protect our core asset, which is really around the imaging system and the algorithm itself.
Okay. Your next question comes from Ari Lunan. Please go ahead.
How does the current state of LBT affect the sales process? So when your customers are looking at LBT and they're buying a machine from you, what are they thinking? Is this company going to be around for more than 12 months or whatever, because the share price is at half cent?
Yeah, thanks, Ari, for the question. Look, I think, it kind of goes to the significance of being successful in this current entitlement offer. And I think the observation that you make is one that is certainly relevant. And we have had some discussions with more on the pharma side of the market. I think getting through this capital raise clearly increases and bolsters our balance sheet, and that's only seen as a positive on a go-forward basis for the company in our discussions with companies who might look to ask that.
Okay. The next question is from Peter Gregory. Please go ahead.
Brent, if I can be quite blunt, my question goes to a credibility one. The clinical business has been in place for quite some years, and the average sales, I think, since about 2019 has been about $2 million a year. The product, to me, has a very clear value proposition, and you've had fairly positive projections as to how that product would play out. I'm having trouble understanding why the sales have plateaued at what seems to me to be a fairly low level, given what I think is a very strong value proposition the product has. Could you comment on that?
Yeah, no, fair question, Peter. Look, I think when we look at, and you're right, we launched in 2019 the product, and obviously COVID kind of got in the way there. But I think the blunt response is it has not met the expectations internally in terms of the adoption within the market. And when we look at trying to understand it and uncover what the issues are there, we are convinced that longer term and over a period of time that APAS has a place within the clinical market, and it does address an unmet need, which is kind of what I said in my opening comments. I think what we are finding, though, is that when we're looking to sell into clinical labs who are under-resourced, we still require the customer to do something. So we require them to validate the technology. There is time that's taken out of their business as usual activities that they need to prioritize and they need to schedule. And what we are finding as we go through that sales cycle and we go through that sales process is that's just taking far longer than we would have expected. And it's a factor of the market dynamic and understanding who our customers are. And I think what we've concluded is that we don't expect the nature of which those engagements occur to materially change. It's a factor of the customer who we're selling to and I guess the behaviors and the challenges that they've fundamentally got within their workflow as an organization.
Okay, thank you.
Peter,
Brent, if I could just follow up and just simply say what makes the pharma market different?
Yeah, there are many differences with the pharma market, and the benefit of hindsight's really great when you kind of look at those the two market segments. But I guess look, the proof point with AstraZeneca, who's funding $1.1 million of R&D funding towards helping us move from what was an initial feasibility study through to full development and bringing that product to market, I think is a significant demonstration that there's an opportunity within the market. And so we've got genuine customer pull. I think that's an example. That's a proof point that exists that we've just never had on the clinical side. The other aspect I'd say is that because drug manufacturing is a highly regulated process, there's a lot of standardization across drug manufacturing sites within AstraZeneca and within other big pharma customers. And what that means is that they have a centralized team who typically look at data, trends, new technologies, and are focused on improving all of those aspects. So in other words, you've got a centralized group who are accountable and responsible and are funded by the organization to adopt new technology, to look at process improvements, and to monitor trending. That same benefit of funding, if you like, or processes within organizations on the clinical side of the business just doesn't exist. So they're just some of the differences that we've seen in the behavior of our customer when we're considering and looking at the interactions that we've had now, both on the pharma side relative to the clinical side.
Okay. The next question comes from online. It's anonymous. There were 20 advanced sales that haven't been converted. Now pharma sales have been delayed to the second half of 2024, previous first half. What can we expect between now and the second half of 2024? Why is APAS not selling?
Yeah, look, so a few kind of questions there. I would say just from the first part, we wouldn't describe the pharma sales of being delayed. We've just put an expectation recently into the market that we are expecting to finish the development early in 2024 and would look to progress sales in the second half of 2024 calendar year. So I'd probably describe that as being an expectation we've recently put into the market about when we're expecting those sales to start happening following the completion of the R&D work for that product. In terms of what we could expect on that clinical side, perhaps when talking about those advanced sales opportunities, it just links back to my, I think, statement during my initial address, is to say that we would expect continued build of sales between now and certainly the next 12 months, and we would expect that to be at or above our previous sales performance for calendar year 2023.
Thank you. Another question online from anonymous. Given the significant dilution as a result of the raise, deterioration in LBT's financial position, failure in executing the numerous advanced sales opportunities to date, how can the board justify the executives' remuneration packages where bonuses are continually issued for underperformance? How can shareholders be confident that the raised funds will not be used for rewarding the underperforming management team?
Debbie, I'm happy to pick that one up. I can't speak for board decisions prior to my commencement, but I can certainly tell you since stepping into the chair role that we have set very specific KPIs for both Brent and his team. I can also say that they will be evaluated strictly to that criteria. Brent's bonus was not paid out in full for this last financial year, and that takes into consideration some things that are within his control and some things that are outside of his control. But his bonus was substantially reduced given the performance of the business. I can also give you my surety that going forward we are going to be acutely focused on cash preservation and ensuring that we are directing the money into areas that can progress our business. It's a fine line. We need to ensure that operationally we are doing what we said we are going to do, but we also need to ensure that we are motivating the team to be able to deliver on what we expect of them as well.
Okay, thank you very much. Next question is online from Matthew Dowling. Basically, I think he's asking if there's any reoccurring revenue on the pharma side.
Yes, there is, Matthew. So it's a similar principle to the clinical application where we sell the instrument for $300,000 and then there's an annual software license, which is a reoccurring annual fee of $30,000. So that's for the new analysis module, the APAS Pharma QC analysis module, which does work differently to the clinical application, but obviously using the same technology stack that's developed through APAS.
Okay, thank you very much. Next question is from Andrew Scott online. Given that the return on investment on APAS Clinical is perhaps 2 years, what reasons are potential customers coming up with for not purchasing APAS Clinical? If it worked as what it says on the box, it would appear to be a no-brainer.
Yeah, no, fair question. So look, I think some of the, feedback we're getting is budget allocation, and we're seeing that, I mentioned that in our recent 4C as well. So some real headwinds we're finding with respect to hospitals having the budget allocated. And then the second one kind of following that is just around prioritization. So when you think about, various bits of equipment that is in a lab and looking to replace and looking to renew, it's about, improving the APAS, prioritization within the lab. So they're the two major things: budget and then prioritization to introduce the technology relative to other things happening in the lab.
Thank you. Once again, if you'd like to ask a question, please use the Q&A function on the Zoom control panel at the bottom of your screen, or raise your hand and wait for your name to be announced.
Looks like that's it. Oh, no, one more. I think I saw a hand quickly go up, so if you wanted to just try that again, we'd be happy to take another question.
Yes, there's a question from Peter Gregory.
Brent, can I ask you, and Rebecca also, has there been any acquisition interest in the company?
Look, I think the company has not gone through a process to look to sell the company. And, I think it's one where it's just too early. I mean, I think like many shareholders be aware, any kind of larger company looking to acquire the business would just want to see more traction from a sales perspective in the clinical side. And, because it has been slower than we have expected, there has not been material progress on related discussions around acquisition.
No, sorry, I wasn't asking whether you'd actively sought acquisition. I was interested, had there been any knocks on the door saying, can we have a look?
No, they haven't.
Thank you. Next question is from Russell Hancock. Please go ahead.
You're on mute there, Russell.
Oh, okay. My question was for Brent. Is there a role for the APAS in the global food manufacturing industry?
Yeah, absolutely. Yep. So we see food as an opportunity. You know, dairy could be bundled into that as well. Water, really. You know, when we look at the portfolio of applications, we've kind of focused on clinical. Now we're focused on pharma, but certainly to an extension of food application, there is absolutely an opportunity there for us.
Thank you. Next question is from Anonymous. They're asking what sales have been in the first half, I think in 2024.
2023, yeah. So first half of 2023, there's been 3.
Thank you. Next question is online from Brian Clayton. What are the alternative plans if the entitlement fails to raise 4.5 million?
Yeah, look, I think, Brian, that's where the benefit of the underwriting really kind of comes into play there. So we have got 3 million of committed funds through the underwriting and sub-underwriting processes already. And look, there might be an expectation for that to increase during the time of the entitlement offer being open. So I think the company would say in direct response is that we don't believe we'll be in a position where the entitlement offer will fail. It may not get to the 4.5 million, but we feel very comfortable with the underwriting demand and that security, which is what Beck had said in her address.
Thank you very much. Next question on a similar line from Robert Bertolini. Are you confident of a sufficient cash after this raise to carry until the second half of 2024?
Yeah, Ray, do you want to
yes,
address that one?
Sure. Thanks, Robert. So looking at the capital raise, it is, or the rights issue, it is underwritten, so guaranteed for 3 million. We do expect to raise more than that. And in combination with the fact then that whatever's not taken up of the 4.5 million, the company then has a further 3 months to place that stock at the same price. And it is, you know, unapologetically, we had to price it where it was an attractive offer so that we had a genuine proposition of being able to place that stock afterwards. So I would like to think that even though the rights issue may not raise 4.5 million, we will raise 4.5 million. In terms of getting through to June, when the AstraZeneca sales are expected to start, our gap is about $4 million. In addition to the capital raise, we have, so when I say gap, sorry, just to clarify, that's our funding need. So not taking into account the rights issue, we have expenditure over those 9 months of about $4 million. And over that period, we have AstraZeneca income coming in. We have the research and development tax incentive. We can finance. We have a small amount of license fees for instruments that are in the market. So that comes down significantly. Then you put in the funding as well from the rights issue. And there's also the options that fall due, and we did that for a particular purpose in September of next year, priced at the same amount as the capital raise. So we'll be very focused on delivering what we need to for the market to make sure the share price is above that. We don't believe, as we sit here now, that we need that money, but it's a buffer, it's a backup. So short answer is yes, we have crunched the numbers and we are reasonably confident based on what we see that that's enough.
Thank you, Ray. Next question is online from Russell Hancock. What is your competitive advantage over your competitors?
Yeah, so look, we have a standalone automated culture plate reader. There is no other product that does what our product does. And so the competitive products, like I mentioned, is a total lab automation solution, and it involves having an incubator and a reader combined, and requires multiple reading points along the way. And so, we still, after this time frame, remain completely unique as a standalone automated culture plate reader. So differentiated with respect to, I guess, form, fit, and function, and differentiated significantly with respect to price.
Thank you, Brent. Next question online from Peter Lim. With the appointment of a new chair and underperformance to date, has an independent strategic review been undertaken to identify the underlying issues and formulate response? How can shareholders be confident enough to participate in the raise when directors have not demonstrated their confidence in the company by purchasing shares online, the market?
Thanks, Peter. I think it's obvious for me to pick this one up. So, certainly when I joined, my sort of first two priorities were to do exactly the things you're pointing at. One is that, I came in knowing that the business needed to raise money, and that is a really uncomfortable position for a new director to put herself in. In parallel with making the decision to join LBT, I certainly did substantial diligence on the things that everyone has raised today around the underperformance, where the opportunity in the future lies, and have stepped into this role with some confidence that there is a new pathway for this business, and that pathway is something that I certainly felt that I could support. In parallel with that, the capital raise activity over the last couple of months, the board has spent considerable time in weighing up our options for capital and looking at the alternatives that we had. We absolutely have focused very squarely on where we are today and what the issues have been, that have influenced to where we are today, and really looking at addressing that. And we believe that, the questions that we had around the business have been satisfied. And as I said, we go into this coming year with some confidence that Brent and his team can take this business forward, to the extent that, I've brought forward my whole entire, in fact, more than my entire director's fees for the year forward to participate in this raise. All of the other directors, except for Brian, who was unable to participate because we can't offer this raise to US citizens, have participated. And it's, I think, also important to note that, whilst some directors might not be purchasing shares on market, they are taking their fees in shares. And so I do believe that the board is aligned with shareholders. We've put our money where our mouths are. We're standing behind this business, and we're here to support it. I think the other point to make is that, the underwriting of this should give investors and shareholders some confidence, to go forward. They've taken the risk of putting the capital up front, looking at the same things that I have in terms of the prospects for the business.
Thank you, Rebecca. Next question is an anonymous question. Would the cash need change if the company were able to convert any of the sales in its pipeline?
I think the short answer is yes. Obviously, sales allow, inflows for the company. So short answer is yes.
Thank you, Brent. Do we have any more questions? Oh, we've got another question from Robert Bertolini online. Just to clarify, if I buy 100,000 rights, I will get 400,000 shares and 200,000 options expiring in 10 months and 200,000 expiring in 24 months.
Ray, do you want to take that one?
Yes, absolutely. Yeah, that is the arrangement. So the entitlement is 4 times the amount of shares held, and the same amount in options, 50% for shorter dated ones and 50% for longer dated ones.
Thank you, Ray. Are there any other questions? Yes, we've got a question from Russell Hancock online. Not online, sorry, voice.
Yes. Just one more question. Looking at the structure of the offer there and the schedule of dates, I found it a little confusing then that the shares were trading on a deferred settlement basis for such a long time, from the 3rd of November right up until the offer closes, on the 9th of November. Is that a bit unusual?
Sorry, I'm just getting the
key date.
Do you mean, sorry, Russell, do you mean allocated traded 3rd? So there's a difference between the 9th and the 3rd of November?
I'm just reading what it says here on the announcement, that the securities quoted on a deferred settlement basis from the 3rd of November, but then the entitlement offer doesn't close until the 9th of November.
Yes, and obviously there's a weekend in between there, so it's 3 trading days, so the Monday, Tuesday, Wednesday.
Okay. 6 days of trading day. Anyway, it seemed a bit unusual to me. I haven't seen that much.
That is the we've run the timetable through the ASX and their mandated timetable, and this conforms with that.
Okay.
Thank you, Russell. Next question is online from Howard Button. Why are US buyers excluded?
Yeah, look, it's really legal and compliance costs associated with expanding it into that jurisdiction. So it just didn't make commercial, or I should say economical sense, to spend the money to go through the additional compliance. I mean, as you see, the prospectus is quite a long document, and the company goes through a fairly extensive process with our lawyers and also the ASX to make sure that we comply with all the various regulations that are needed. So considering we really don't have many shareholders that are US domiciled, it didn't make sense for us to expand it into the US for those reasons.
Thank you, Brent. Do we have any other questions? Yes, we have another one online, again from Peter Lim. Has the company explored alternatives to selling the machines? For example, renting or leasing the machines? Part of the problem seems to be the reluctance associated with putting significant upfront cost for a machine within an unknown lifespan.
Yeah, so the short answer is yes. So Thermo Fisher have fairly recently put in place various leasing and reagent rental models for customers. So good suggestion. And yes, it's part of the selling kit, if you like, of tools that are available for Thermo Fisher.
Thank you, Brent. We've got an anonymous question online. Was the debt's loan structure considered in lieu of the capital raising? Seems that this may have been viable to establish a 12-month cash runway.
I might just jump in, Brent, and you can build on this. I think there's 2 considerations here. One is we saw the type of influence that the Lind facility had on our share price and sentiment on our company over the since taking that facility on earlier in the year, and certainly a big focus for us was getting rid of that sort of debt facility. So I think that's number one. Number two, to get a debt facility that was attractive to the business, given the variability and uncertainty of when the revenue was going to fall, meant that the terms of debt would have been substantially under what we've been able to do from an equity perspective. But of course, we looked at every option. And I think just to expand a little bit, as we were going through this process, we evaluated very deeply 4 or 5 different funding options for the business, all of which were substantially suboptimal to the structure that we've presented to shareholders today.
Thank you, Rebecca. We have a question from Russell Hancock.
Just to follow up about the question I asked earlier about the trading of the shares on a deferred settlement basis, I should explain myself there. So there's 4 days there of trading, and possibly the share price then can influence the uptake of the issue. I mean, it could go either way depending on what happens. I mean, it could be that the share price is higher, and then people might be encouraged to take up the offer, or it could be that share price plummets due to people selling their old shares. So that's the aspect of that trading arrangement that worries me.
Thanks, Russell. I mean, I think probably just best to say, look, we obviously can't provide advice around whether it makes sense or not for your own circumstances to buy or sell, and so I don't think we can provide too much more commentary on it.
I would add in just to clarify though, as I said before, I'd be interested in some other examples, because those dates in particular are ASX mandated in their timetable. So it is in compliance with that as we need to.
Thank you, Ray. Are there any other questions?
All right. Well, look, thanks everyone for joining today's call, and hope that was helpful in terms of being able to provide some clarity around the background and importantly, the outlook for this business. Thank you very much.
Thank you.
Call is now over.